So one more question before we start talking about into the future.
I got
I'm
Nathan
curious
interested
about
in all these
fast
other
here.
notes
I
now.
Yeah. No,
know.
Brain's
I find
going.
it fascinating. And that's actually Marty Granoff. That's in that 2009 conference. That's what he was talking about, lottery winnings and stuff. And I just like blew my
Yeah,
mind.
Marty
You
was
can do
Marty was
that.
back in the
It's
day.
crazy.
Yeah. Well, see,
Yeah.
back then there was no lump sum in the lottery. When you won the lottery, you
Right.
would
Yep.
win $1 million.
It was always
You get a
Annuity.
20 or 30-year annuity. So you're getting
right.
after taxes, maybe 30 grand a year. And because it was
Hmm.
public, we would reach out to you and say, look, would you rather have 600,000 now or 30 grand a year for the next 30 years?
Yeah, of
And a lot of people would say, I'll take the 600,000. So we pay the
course.
600,000 and then we collect the payments. And everything is guaranteed by the state. So the
Yeah.
collateral
Oh,
is the state.
Yeah.
golden.
Now,
Which is
ironically
crazy.
enough, do some Google searching, everybody, and you'll find that Illinois defaulted on lottery winners. Did you know that?
Did not know
It
that.
was about 2, 3 years
Really?
ago because their budget is
Oh,
so out of control. Lottery winners, they just couldn't pay them.
Wow.
So they so
Oh, ouch.
they defer. You imagine that? They deferred that. So back then, we were the source. We were the ones that were cashing people out. And the
Uh-huh.
states caught wind of that, and they looked at us as an industry and said, "Well, you guys are making too much money, on these. You're buying them making 18% returns or whatever it was,
yeah, yeah.
probably higher." So they didn't say you couldn't do it, but they said if anybody sells their lottery winning, the state has the right to discontinue payments.
Wow.
Which
Oh,
effectively you're like, well, then
whoa.
so the industry overnight
Uh,
changed, and then very shortly afterwards, all of a sudden the states offered a lump sum. And when you go back
okay.
and calculate the yields, we were much better. We were paying a lot more money than the
Uh-huh.
states are today.
Uh-huh.
Yeah.
It's just crazy, but that's how it worked.
So I'm
Oh,
curious, like back when at the 18% interest days, when people were offering, well, I'll just give you 9%,
9% seller financing. Yeah.
was that was were there ever people doing that to scale? It seems like surely there must have been like people that would do like, several a month instead of just like one-offs here and
Well,
there.
these were really the bulk of that inventory back then were consumers, what I call today the mom and pop loans.
Yeah.
mhm.
These are somebody who, inherited a house or owned a house free and clear, and they just couldn't sell it because
Yeah.
nobody wanted an 18%. So they said, we'll find, and that's the only note they've ever created. So it wasn't really a business that was buying
Interesting.
houses and like today where they're buying houses and then selling with financing.
Yeah.
This was typically a consumer. And
Gotcha.
that's a big play today. Or
It
I know we're
is.
going to move forward to some of these other notes, but that's a great funnel
Yep.
to look at because those consumers who own those notes, a lot of them don't even know they can sell them.
Yep.
Right.
And if the economy gets tighter, things are getting more expensive, inflation's getting up. A couple of the precursors to non-performing mortgages are credit card debt and
Yep.
automobile debt, both of
Mm.
which are getting historically high again. And
Yeah.
default rates are getting historically high again. So the next
Mhm.
domino typically is the mortgages. So you're going to have some of these mom and pop note owners who just own one note. That's all they've ever had. And boy, they'd rather get cash now.
Yeah.
They become
Yep.
Absolutely.
motivated sellers. And then, you're not competing with, people on tapes and bidding and all that sort of stuff. You're reaching out
Yep.
directly to a person. And
Yeah.
today you can still buy names and addresses of people that fall into that,
Yep.
that.
Interesting. Yeah, because that's
Yeah.
that's a funnel that both Dave and I are seeing are people that are doing it as a business where they're
Yep.
acquiring property, selling it on a note, and then they're like, wait, I can sell that? Awesome. And
Yeah.
then they'll
Yes.
they'll sell it to somebody like us. And
Yeah, and that's inevitably what happens is you will, if you're pursuing those mom and pop notes, you will run into somebody who does it on a regular basis. We
Yep.
right.
just bought a client of mine just bought a deal a couple of months ago in Louisiana, and it was doing our research on the thing. The guy who owned the house, sold it with financing, is carrying back the note. We looked him up,
Mhm.
and he's doing it through a real estate company. Well, 2 seconds on public records, and
Yeah.
I thought this guy sold like 40 of these. So not
Yeah.
only does he have this note, but he's got probably 40 other notes. And I told my
Sure.
client, follow up with this guy. You're buying this one. You want
Yep.
to be his go-to guy.
Yep.
And by the way, as he's pursuing those 40 notes, he can't afford to buy all of those 40 notes. Doesn't have to, right? Because
Nope.
he can buy the ones that he likes, and then what?
Yep. Share them over
Sell
to
the other
you.
on the
Yeah.
other ones, right? Yeah.
Yeah, exactly. Exactly.
Yeah.
So before we got on the
That's cool.
call and before we get into the big topic here, I wanted a key thing in. We've been approached, Nathan and I, about wrap notes and buying wrap notes,
Yeah.
and we're just gonna hit this point and move on. Kevin, when you're gonna buy a wrap note and there's an underlying lien that's not the seller of the note, there's an underlying borrower that's a third party borrower. What do you do with that first lien? Are you taking over the first lien, or are you doing what Nathan and I are doing and having to pay that lien off?
100%. Anytime you buy wraps, because it's not a new concept. We're starting to see elevated inventories, but again, years ago we had a lot of those wrap mortgages too before the big crash of 2008 and such. And
Mhm.
you just lock it in your brain. If you're buying a wrap, out of the proceeds of that, you absolutely have that underlying first paid off. And by the way, that's done automatically. Don't give that money to the person you're buying the wrap from and say, now don't forget to pay off that underlying loan. It's handled separately, right? You go, boom, you
Right.
send the money there and they get the
Yeah.
rest of the money. But that's the only way to do it.
We get
Otherwise,
so many rap people saying, "Why are you paying off 3% debt?" And the answer is, we're going to. It doesn't. It may not make sense to you, but we have to.
some of the things that you can run into with that and some other type of notes is you can buy a note and get lucky and not really go through all the due diligence and miss some of the missing paperwork and
Mhm.
gloss over some things. But the way I always look at these and the way I teach my clients is, sure, if you don't correct this now, it's never going to be a problem if the person pays. But
Exactly.
what you don't want to do is identify something or miss it and not have it corrected, and then 5 years from now it's a huge problem. Now,
Absolutely.
now you're in trouble because they stop paying, and you're
Yeah.
trying to fight it, and your legal expenses and time frame and everything else goes through the roof, and you just can't do
Mm,
it that way. So you've got to look at these things always as we'll hope for best case scenario, but prepare for worse.
Yeah.
absolutely.
Yeah.
So 2023 was a weird year. Talking earlier about that, and what we're seeing is some new kind of inventory start trickling out, right? And we talked off air about this. Is that the mom and pop first lien, second lien residential houses are kind of being kind of on still right now, but there's new inventory coming about, right? This 2024 inventory is something that we haven't seen a lot of in the past. Can you
Mm-hmm.
share some of your thoughts on
And
where's it
like you
coming
said
from and
before,
why?
like it's always
Yeah.
shifting. You were doing
Yes.
you were doing those seller finance deals, and then you go to lottery winnings because that works. The lottery
Yeah.
winnings all of a sudden are no good, so then you move to something else. And so what are we seeing today?
Yeah, in the market today, it's the smart play right now is performing notes, and it has been for the last couple of years. A lot of these notes are reperforming notes that came out of the non-performing notes that we were all buying
Mm-hmm.
back in 2008, 9, 10, 11, 12. So
Yep.
non-performing was the play back then because inventory levels were elevated, prices were down, and there were great opportunities with government funds and everything else. That was the proper play. Now, a lot of those loans that were purchased non-performing and are reperforming, they've been reperforming for 10 years
Yeah.
and equity has gone up. So you can find a lot of very good performing notes. And that would probably be the easiest way for anybody listening or watching this
Mm-hmm.
to get involved in notes. Buy what I call a nice turnkey note, at
Yep.
least 2 years of payment history, at least 30% equity in the property. And you're going to be good because you can buy those in about a 10 to 12% return all day long. So that's an easy play and it's a continued play. I saw too many people. I know we had people going, oh, the big crash is coming. I wasn't one of those people. I said, there's too much equity,
Yeah.
and banks really are pressured heavily by the government because of Dodd-Frank, which changed everything in our industry, by the way. But because of Dodd-Frank, banks are highly pressured. If somebody's in trouble and they have equity, you got to work it. You got to work with them. You got to do a workout. They don't go right to foreclosure because you got to remember the government owns over 90% of all the loans. The
Very
banks are
true.
just the base. Fannie Mae, Freddie Mac, and Ginnie Mae actually own all these loans. So that funnel that we used to have of non-performing loans, which were bank originated loans that were sold by auctions and trickled down, that funnel's been squeezed. That's really a small amount of of inventory today. What's bigger is you've got the companies that bought those non-performing notes, got them reperforming, and now they're starting to cash out of their portfolios, leaving a perfect scenario where you can, just small example, you got $100,000 house, but they only owe 30 grand now on the house. And you're paying less than 30 grand for that note. You know, your investment to value ratio, you're perfectly safe. Even if property values drop 20% in that example. All right, now your collateral's worth 80, but you're still in it for less than 30. Makes a lot of sense. Proper yield and those sorts of things all come into play. So those are really good. Another part of the partials that is especially good for beginners, but also I'm looking at a lot more with clients of mine is buying partials. You know, instead of buying a whole performing note, just come in and buy a partial, because again, you lower your risk. You're getting the same type of returns that you could get, if not higher, on that. And you have a vested party who owns the back end of that note that wants it to go well also. And I think that makes a nice combination, because some people are starting to price these performing notes a little too high. And usually the market gives some pushback on that, and it takes some time. But what I found is even a lot of people who are selling notes, they you know, they're not trained, you know, to the fullest extent, and they don't even think about selling a partial. But when they look at it, they go, oh, you know, well, that can make a lot of sense. So it's opening up an opportunity to get around these people who are you know, pricing the market without having them to, you know, wait and react and go, gee, why isn't my note selling in, you know, 90 days? I've had it listed on paper stack or something, you know, and it's not selling. Well, because it's priced too high. So either lower your price or, you know, do some kind of a partial. But those are good, easy notes to get into. Emerging notes, new notes to the industry. We're starting to see the home equity conversion mortgages, which all HECMs, as they're known as, and also we're starting to see these short-term bridge loans. And those are pretty new to the industry. And so it's time for everybody listening and watching, learn about these things, study them, because they're starting to grow. For example, the bridge loans. These are typically 2-year loans, sometimes 1-year loans that are given by private investment companies, sometimes private individuals, that are typically high rate, and they're meant for a short payback period of time. Not quite hard money loans, but they're, you know, bridging the gap between getting regular financing. So a lot of times the properties are being renovated. You know, so you got a private investor buying a piece of real estate, needs money. They go to a private lender, say, lend me the money for a couple of years. I'll get it fixed up. I'll get it rented. I'll get whatever. Then I'll cash you out by refinancing, because I've improved the value. Great. The problem that they're running into now is, because of inflation, the original numbers that some of these people looked at a year ago, where they said, okay, we're going to buy the property for this. Here's what our fix-up cost is going to be. Here's our after repaired value. Here's our typical days on market. Those numbers have fundamentally changed.
Wow.
Lumber prices, appliances, I mean, every expense involved in renovating a house is much higher. And that's starting to squeeze those margins for the real estate investor who's supposed to pay back this loan. And when they start to recalculate, and labor's up too, right? So when they start to recalculate their numbers, they start to see a profit margin that's just either unacceptable, or they're upside down and they're walking away. And it's easier sometimes for these investors, the real estate investor, to walk away, because most of the time the loan's not in their name. It's in an LLC. And so they have no personal liability. I would never, by the way, if I'm doing a loan for somebody, which I have done a lot of those, and somebody in rehab, they're personally signing that as well, because I want that pressure of, it's going to affect their credit. If it's not affecting their credit, it's easier for them to walk away. And now you get a money lender who has this non-performing loan and a half rehab property, and they're not in the business of renovating. They don't want to get in that business. So instead, what are they doing? Selling non-performing loan, short-term loan. And this is where, you know, those of you who do have real estate backgrounds, especially, like I said, I've done 150 rehabs, and it's no problem, you know, if you have that mindset of going, well, again, do my numbers work? You know, if I could buy this note at a deep enough discount, then I can finish the house myself and sell it to somebody with financing. Or a lot of times what I advise people to do, I'm in a situation right now with a client who's taken a property back and it needs rehab. I said, well, partner with a rehabber. You just had a guy go out and secure the property. He's looked through the whole thing. He's taken
Yeah.
pictures of the thing. So
Yeah.
finance it for him. Let him fix it
Yeah.
up.
Yep.
And you guys, split some of the profit. In the meantime, he's paying you, and then you sell the property, and you guys do some kind of a profit split. So there's a lot of,
Absolutely.
yeah,
And
Yeah.
that's an interesting play is that there is a lot of rehabs kind of falling off the wayside. And I think a lot of no investors gotten lazy over the years, not wanting to do anything manually, right? And I think that if we just get out of our own way, we're going to actually make some more money on the fact of buying these assets are non-performing. Because you're right, like the banks in 2008, 2009, 2010, they weren't doing a lot of foreclosure. They want to get rid of the assets and allow other people to do the foreclosure. And that's where we stepped in. And
absolutely.
if we can be that solution for these people, they're more than willing to sell off those assets to allow it to get off their books so they can go buy another, lend that money back out, just like the banks did back in the day.
Yeah.
Good play.
Yeah. And,
And
in my mind, and I've said this for years, I've been training in this business for well over 25 years now. And one of my key concepts was always, if you truly want to master this, you have to understand the numbers and the story. It's got to be
yeah,
both. If you just look at the numbers, at some point in time, you're going to get burned because you didn't know the story. If you
totally.
just know the story, not the numbers, at some point in time, you're going to get burned. So part of it is unpeeling this onion here to
Yep.
find out, and then just do your numbers make sense. And if you know the story, you have a lot more of an educated guess as to what the workout is going to be. What's the most likely scenario, least likely scenario? And if I can make money on least likely to most likely, I'm good.
Yeah.
I'll
Which,
make money. It's just a matter of how much and when. Because sometimes, again, we don't know exactly how it's going to work out because sometimes,
yeah.
it's not totally in our control. Yeah.
Which again comes back to a point that we've hit on many times. Like, uh, for any kind of note, if you're doing a seller finance, get it with a servicer. And the
Yes.
servicer is going to keep records of those conversations they've had with the borrowers, which is really invaluable to us because we want to know the story.
Oh,
How
yeah.
likely is it that something's going to happen? And
Yeah.
what's been the history? Where's it going to
No,
go?
yeah,
Yeah,
Get a
knowing the
better
because
borrower
sense of it.
there's some
stories
sellers,
too.
that don't
Yeah.
provide that, right? They have
Right.
access to it, but they don't provide that. But boy, when the ones that they do, it's like, oh, this is going to be some good reading here, right?
Yeah. Yeah.
I'll find out everything that's been going on with
Yeah.
this deal. Yeah, yeah,
And
And
sometimes you find
sometimes
out
it's
that,
as simple as, there's bad blood where they've had, an argument with the old note holder, and now you're stepping in, you're the great guy that's going to solve everything. You're not going to do anything different than the last guy, but you're somebody different, and that's all that
we've
matters.
also seen it where the servicers didn't communicate